The move and what it actually means. BlackRock manages $12.53 trillion in assets as of June 2025, the world's largest asset manager. They're not just managing money, they're shaping where capital flows globally. Here's what happened in 2021. BlackRock moved $2 trillion in custody assets from State Street to Citigroup, JP Morgan, and BNY Mellon. That wasn't an investment strategy shift. It was an administrative reallocation of who holds the assets. But here's what matters now. Since 2024, BlackRock's actual portfolio composition has changed dramatically. They've reduced long-term U.S. Treasury exposure and increased allocations to emerging markets, European infrastructure, Asian real estate, and commodities, including gold. In 2024 alone, BlackRock's iShares ETF franchise captured $641 billion in net inflows, representing record client demand. By Q3 2025, their total assets under management hit $13.5 trillion, up 17% year-over-year. Institutional assets make up 52% of their AUM. And alternative investments, though only 3% of total assets, now account for 17% of base fees. When the world's largest institutional investor shifts strategy, it's not guessing. Responding to mathematics, currency trends, GDP growth trajectories, demographic changes, and valuation opportunities. Understanding where they're positioning capital today reveals where returns are likely accelerating tomorrow. Why smart money is rotating now? Multiple converging factors are driving this capital reallocation. And they're all measurable. Valuation gap. The S&P 500's concentration risk hit historic levels in 2024. The Magnificent Seven tech stocks now represent over 30% of the index, the highest concentration ever recorded. Only 28% of S&P 500 stocks outperformed the index in 2024, marking the second narrowest year in nearly 3 decades. When fewer stocks drive all returns, the risk-reward equation changes. U.S. debt trajectory. National debt reached $38 trillion in October 2025. Up from $36.1 trillion in January 2025, that's $1.9 trillion added in just 9 months. Interest payments on this debt now exceed $1 trillion annually, more than Medicare or defense spending. This creates structural headwinds for dollar strength long-term. Performance reality check in 2024. The S&P 500 delivered 25% total return, excellent performance. But compare this to international markets. Emerging markets have shown acceleration. Japan experienced a corporate renaissance. European markets benefited from infrastructure investment. The growth isn't abandoning America, it's expanding beyond it. Institutional positioning. BlackRock reported $5.42 billion in Q2 2025 revenue, up 13% year-over-year. Their alternatives segment nearly doubled to $663 billion in Q3 2025, up from $334 billion 1 year earlier. This isn't speculation, it's calculated, probability-weighted allocation toward where incremental growth is accelerating, where the capital is actually flowing. BlackRock's reallocation targets 3 specific regions with measurable economic catalysts. Emerging markets broadly, countries including China, India, Brazil, Taiwan, South Korea, Mexico, Indonesia, and Southeast Asia. India maintains GDP growth above 7% annually. Indonesia sustains 5% plus growth. These economies feature younger demographics, populations entering peak earning and spending years. Manufacturing capacity expands as global supply chains diversify. Corporate governance reforms in countries like South Korea and Taiwan are improving shareholder returns. Japan's structural reset. After 3 decades of stagnation, Japan has fundamentally transformed. Corporate governance reforms now prioritize shareholder returns. Companies are executing stock buybacks, increasing dividends, and improving operational efficiency. The yen trades around 150 to the dollar, making Japanese exports globally competitive. Major manufacturers like Toyota, Sony, and Mitsubishi are experiencing profit margin expansion. This isn't a comeback story, it's a structural reset. European infrastructure and real assets. The European Union's 1.8 trillion euros recovery fund channels capital into renewable energy, transportation networks, and digital infrastructure through 2027. BlackRock increased exposure to these projects specifically. Commodities reclassification. Gold and silver were reclassified as Tier 1 liquid assets under Basel III regulations implemented progressively since 2019. Banks like JP Morgan and Goldman Sachs can now use gold at 100% value for reserves. Both metals hit all-time highs in 2024. The 3 key ETFs with verified performance. Individual investors can access the same markets through 3 established ETFs. Here's what the actual data shows. VWO Vanguard FTSE Emerging Markets ETF 2025 return 25.61%. 2024 return 10.59% assets $115 plus billion. Expense ratio 0.08%. Top holdings: China 24%, India 21%, Taiwan 18%. Ultra-low fees and broad emerging market exposure across 6,000 holdings. Tracks the FTSE Emerging Markets All-Cap China A Inclusion Index. EWJI shares MSCI Japan ETF 2025 return 31.17% 1 year. 2025 YTD plus 1.51% assets $14 billion. Expense ratio 0.50% captures Japan's corporate transformation and currency advantage. Holdings include Toyota, Mitsubishi, Keyence, Sony. EEMI shares MSCI Emerging Markets ETF 2025 YTD plus 4.44%. 2024 return approximately 7% assets $24 billion. Expense ratio 0.68%. Broader diversification than VWO with different index methodology. Includes 1,247 securities. Higher expense ratio but extremely liquid with active options market. Tracks MSCI Emerging Markets Index. What this means for your portfolio. This isn't about abandoning US stocks. The S&P 500 delivered 25% in 2024 exceptional performance by any standard. Technology, defense, aerospace, and AI remain American-dominated sectors. But concentration risk is measurable and real. The Magnificent Seven now represent 30% plus of S&P 500 weight. In 2024, only 28% of S&P 500 components outperformed the index itself. Concentration hasn't been this extreme since 1998 to 1999. When growth concentrates in fewer names, diversification becomes essential. BlackRock manages $12.53 trillion across pensions, endowments, sovereign wealth funds, and central banks. When they reduce long-term treasury exposure and increase emerging market allocations, they're responding to probability-weighted scenarios built from decades of institutional experience. Practical strategy: don't liquidate U.S. holdings. Instead, add 10 to 25% international exposure through the ETFs above. Rebalance annually. Stay patient through volatility. Emerging markets don't move in straight lines. Most investors wait for certainty. Certainty only arrives after obvious confirmation, which means after returns are captured. Institutions move on probabilities, not guarantees. The takeaway: don't panic, don't chase headlines. Watch where trillion-dollar capital flows are heading, then position accordingly. Follow the data, not the narrative. Position early, stay patient, let compounding work.